This isn't a bank failure. It's a confidence test. A U.S. bank failed. Regulators moved quickly. Deposits were protected. The resolution was described as orderly. That part is accurate. But accuracy isn't the same thing as relevance. Because this isn't a story about panic. It's a story about probability being quietly repriced. This isn't about one bank. It's about whether the system still inspires enough confidence to absorb stress without changing behavior. And the data suggests that confidence is being tested. Today is a very multiple type of the challenges with her brig. Let's be precise about what happened. On January 30th, regulators closed Metropolitan Capital Bank and Trust in Chicago. The FDIC arranged a transfer of deposits to another institution. Customers retained access to their funds. By the formal definition, this was an orderly resolution. No depositor runs, no emergency weekend summits, no visible contagion. If you stop there, the conclusion is reasonable, a contained local failure. But financial systems don't fail in isolation. They fail when pressure accumulates across similar exposures and begins to cluster. That's the lens that matters. Today is a very multiple type of the challenges with her brig. So what pressures are actually building? They're not speculative. They're measurable. The first is commercial real estate. According to the Mortgage Bankers Association, roughly $957 billion in U.S. commercial real estate loans were scheduled to mature in 2025 alone. That number isn't a forecast. It's a date on the calendar. When loans mature, borrowers have to refinance. And refinancing today is fundamentally different from refinancing 5 years ago. Rates are higher. Valuations, especially in office-heavy markets, are under pressure. Vacancy rates remain elevated. That combination tightens the math. Debt service coverage weakens. Appraised values fall. Equity cushions shrink. And refinancing options narrow. This matters because commercial real estate exposure is concentrated in regional and mid-sized banks, not the largest institutions, the ones without the same capital buffers or diversified revenue streams. That doesn't mean failure is inevitable. It means sensitivity to refinancing stress is higher. Today is a very multiple type of the challenges with her brig. Now consider what happens at maturity, step by step. A loan comes due. The borrower seeks to refinance. The new rate is higher. The property's value is lower. The lender either demands new equity, extends the loan, or takes a loss. In many cases, extensions have been the preferred path. Market research shows that loans scheduled to mature in 2025 have increasingly been pushed into later years. This is often described as buying time. Buying time can be rational, but buying time also concentrates risk. When maturities are extended rather than resolved, pressure doesn't disappear. It shifts forward. And when many institutions do this simultaneously, refinancing risk can cluster instead of dissipate. This isn't conjecture. Research from the New York Federal Reserve documents what it calls extend and pretend behavior in commercial real estate lending. Impaired loans are extended to avoid immediate loss recognition. New credit formation is reduced. Future refinancing pressure increases. This describes behavior, not intent. But behavior is what markets respond to. Today is a very multiple type of the challenges with her brig. Another piece of the puzzle is liquidity. Banks don't usually fail overnight. Stress accumulates gradually. Funding becomes more sensitive. Capital ratios weaken. Institutions rely more heavily on backstop mechanisms rather than routine market funding. One such mechanism is advances from the Federal Home Loan Bank system. These are legitimate, stabilizing tools. They exist to support liquidity, but increased reliance on them is also a signal. It suggests that an institution experienced funding stress well before failure became visible. That doesn't prove mismanagement. It doesn't predict collapse. But it does indicate pressure, and pressure is what confidence reacts to. Today is a very multiple type of the challenges with her brig. Zooming out again, patterns matter more than anecdotes. Loan-level research estimates that a meaningful share of commercial real estate loans are in negative equity. An even larger share of office-related loans falls into that category. In plain terms, the properties are worth less than the debt secured against them. These are estimates. They are based on data sets and models. They aren't exact, but they are directionally important. Negative equity constrains refinancing. It increases loss severity if defaults occur. And it forces banks to choose between recognizing losses now or carrying risk forward. Neither choice is catastrophic by itself, but both raise the cost of maintaining confidence. Today is a very multiple type of the challenges with her brig. Exposure concentration adds another layer. Balance sheet screeners used by banking research initiatives treat commercial real estate exposure above 300% of equity as excessive by that measure. That threshold doesn't mean automatic failure. It's a risk classification tool. But when many institutions exceed that threshold at the same time, it identifies where stress is most likely to surface first. Not everywhere, not all at once. In clusters, today is a very multiple type of the challenges with her brig. This is why framing this as a confidence test is useful. Confidence isn't a switch. It doesn't flip from on to off. It erodes through reassessment. Investors, regulators, and counterparties don't wait for confirmation of a crisis. They adjust based on probabilities inferred from public data, maturity schedules, delinquency trends, loss recognition practices, supervisory posture. None of this requires privileged information, which means everyone is reading the same signals. Today is a very multiple type of the challenges with her brig. That brings us to the international lens. Foreign investors don't evaluate U.S. financial stability through headlines. They evaluate it through institutions. They look at whether supervisory capacity matches the level of risk, whether regulatory frameworks remain consistent, whether losses are recognized transparently, and whether stress is absorbed predictably. This isn't ideology, it's risk management. When those conditions appear less stable, capital doesn't flee in panic, it rebalances. Methodically, incrementally, often quietly. That's how confidence adjustments actually occur. Today is a very multiple type of the challenges with her brig. It's important to draw a boundary here. A confidence test is not a verdict. It does not mean collapse is imminent. It does not mean a systemic crisis is inevitable. What it means is that the margin for error narrows. When confidence is high, systems absorb shocks easily. When confidence is under review, the same shocks change behavior. Credit tightens. Liquidity becomes selective. Risk premiums rise, and authorities feel pressure to emphasize containment because containment itself supports confidence. Today is a very multiple type of the challenges with her brig. That's why language matters over time. When regulators repeatedly describe failures as isolated and manageable, they may be correct in each instance. But repetition also signals frequency, and frequency is what turns incidents into patterns. Today is a very multiple type of the challenges with her brig. So what should actually be watched? Not headlines, data. Watch whether failures begin to cluster geographically or by asset exposure. Watch refinancing calendars, not just delinquency rates. Watch whether extensions continue to outpace true resolutions. Watch office-heavy markets, where valuation pressure remains persistent. And watch regulatory language across multiple events, not just one, because confidence doesn't break suddenly, it shifts. Today is a very multiple type of the challenges with her brig. From a Canadian perspective, this matters less because of direct exposure and more because of linkage. Canada's financial stability depends on predictable U.S. institutions, not perfect ones, predictable ones. Trade, capital flows, and long-horizon investment planning all assume that U.S. financial stress is managed through stable, transparent frameworks. When those frameworks are questioned, even quietly, the cost of capital adjusts. That's leverage. Not dramatic, not political, structural. Today is a very multiple type of the challenges with her brig. So this isn't a story about panic. It's a story about thresholds. Metropolitan Capital's failure doesn't matter because of its size. It matters because of timing, context, and what it tests. It tests whether delayed loss recognition remains viable. It tests whether refinancing pressure can be absorbed without behavioral change. And it tests whether confidence holds as more data arrives. Today is a very multiple type of the challenges with her brig. From here, the cost of pressure goes up, not because something has broken, but because more is being asked of the same system. That's the test. And the outcome won't be decided by headlines. It will be decided by whether confidence holds when the numbers keep coming in.